Picture this. It's 2025, and you're watching the world's second largest economy desperately try to reinvent itself after decades of what can only be described as one of the most successful financial tricks in modern history. China built an export empire by essentially putting its entire currency on permanent discount. And now it's discovering that when you spend 40 years telling the world your money isn't worth much, eventually people start to believe you. This is the story of how China weaponized weakness, turned economic disadvantage into global dominance, and then got trapped in a cage of its own making. It's a masterclass in short-term brilliance creating long-term problems. And honestly, you'd struggle to script a cleaner example of unintended consequences. Before we dive in, if you like having global economic schemes translated into plain English with a bit of dark humor, hit subscribe now so you don't wake up one day inside the next financial experiment without realizing it. The whole thing started back in the late 1980s when China looked around at the global economy and made a calculation that was either genius or completely insane, depending on your level of cynicism. They decided to become the world's bargain basement. Not just cheap, but aggressively, deliberately, artificially cheap. Here's how the strategy worked. In 1994, China executed what was officially branded a currency reform, but in practice was a massive devaluation. The government took the old, overvalued official exchange rate and hammered it down to match the weaker market rate. Overnight, they slashed the price of every single thing they produced by roughly a third. Suddenly, a Chinese-made T-shirt that cost an American importer $1 now cost about 70 cents. For companies like Walmart that buy merchandise by the container ship, this wasn't just a discount. It was a structural reset that would reshape global manufacturing for decades. The financial logic was brutally simple. A weak currency makes your exports irresistibly cheap to foreign buyers. Your goods look like a permanent sale sign to the rest of the world. The trade-off is that your own citizens suddenly find imported goods more expensive, but Beijing decided that was a price worth paying. China effectively sacrificed the global purchasing power of over 1 billion people to become the world's factory floor. Other countries accused China of cheating, manipulating, gaming the system. But Beijing could point to the scoreboard. Factories were relocating to China faster than you could update your labor cost spreadsheet. Container ports exploded with traffic. The strategy was working exactly as intended. But making your currency cheap once is one thing. Keeping it cheap when your economy starts growing like crazy is a different level of difficulty. By the mid-1990s, China ran into a new problem. All that foreign money pouring in to buy their cheap goods was naturally pushing the yuan higher. A stronger currency was the last thing they wanted. So they locked the system down. From 1994 to 2005, China effectively pegged its currency to the US dollar at a fixed rate of about 8.3 yuan to $1. Pegging means you basically promise the world, this is the rate, take it or leave it. No matter how much the economy grew or how many factories they attracted, that exchange rate barely moved. How did they pull this off? Trula, with a financial war chest the size of a small moon. Whenever market forces tried to push the yuan higher, China's central bank printed huge amounts of yuan and used it to buy US dollars. That flooded their own market with yuan, keeping its value artificially low. At the same time, it turned China into the largest foreign holder of US government debt on Earth. The irony is beautiful in a slightly twisted way. To keep their own currency weak, China had to become one of the biggest fans and financiers of the strong US dollar. They were literally funding their main strategic rival's government to maintain their own competitive advantage. This worked impressively well until 2008, when the global financial system decided to have a full nervous breakdown. The U.S. response to the crisis was to print money on a historic scale. Central bankers gave it a polite name: quantitative easing. That's economist speak for we create new money electronically and use it to buy bonds, hoping the shock doesn't kill the patient. If your currency is pegged to the dollar like China's was, this is a serious problem. When the Federal Reserve floods the world with new dollars, the value of each dollar tends to fall. And because the yuan was chained to the dollar, it got dragged down too. Suddenly, China was importing American inflation. The cost of oil, soybeans, and other things priced in dollars started to soar for Chinese buyers. Beijing had to face an uncomfortable truth. Their control over the currency was heavily dependent on decisions made in Washington. They had built their economic house with American bricks, and now the foundation was shaking. Pegging your currency to another country's is like entering a financial marriage. It feels safe when your partner is stable, employed, and responsible. But when they hit a midlife crisis and start maxing out credit cards, you're in trouble too. Fast forward to August 2015. China's economy was slowing, the old hypergrowth model was fading, and the simple formula of just devalue and export more wasn't working as cleanly. Beijing announced a new, more market-oriented approach to the exchange rate. In theory, that meant letting supply and demand play a bigger role in determining the yuan's value, like a normal major currency. Then, in a move of impressive contradiction, they immediately guided the yuan down by nearly 2% in a single day. It was the biggest one-day drop in 2 decades, and global markets reacted like a caffeinated squirrel running into traffic. Investors didn't see this as calm reform. They saw it as a panic move from a government terrified of a hard landing. What followed was a financial stampede. Wealthy Chinese citizens and foreign investors started moving money out of the country as fast as they legally could, and in many cases faster than that. This is called capital flight, when money doesn't trust the future and sprints for the exits. In the year or so following that devaluation, estimates suggest that around $1 trillion left China in various forms. To stop the bleeding, the government had to reverse decades of behavior. Instead of printing yuan to keep it weak, they started burning through their foreign reserves to buy yuan and hold up its value. Hundreds of billions of dollars in reserves vanished as they tried to prove the currency wasn't just a piece of paper with good branding. The lesson here is simple. Investor confidence is fragile. One minute you're the unstoppable engine of global growth. The next, you're frantically plugging holes in the dam with your hands, insisting everything is under control while the water level keeps rising. China tried to project strength by fine-tuning weakness, and the market called their bluff. Then, in 2018, the story added a new character. Donald Trump launched the U.S.-China trade war, slapping heavy tariffs on Chinese goods. A tariff is essentially a tax on imports, designed to make foreign products more expensive and push consumers toward domestic alternatives. For China, this was a direct shot at the heart of its export-driven model. So how do you respond when your biggest customer decides to make your products more expensive by decree? You reach back for your old favorite tool, the exchange rate. Throughout 2018 and 2019, as the trade war escalated, China allowed the yuan to weaken significantly. A weaker yuan made Chinese exports cheaper in dollar terms, offsetting part of the tariff impact. If the U.S. applied a 25% tariff, but the yuan dropped enough to make Chinese goods 10% cheaper, the real price increase that American consumers felt was smaller. This was economic warfare with spreadsheets instead of tanks. The U.S. used tariffs, which are loud and visible. China used monetary policy, which is quiet but powerful. The Trump administration was furious and officially labeled China a currency manipulator, which is mostly a political label, but it captured the mood of the fight. Here's the dark part that rarely makes the headlines. The weak currency, strong exports model quietly punishes your own citizens. For decades, while American and European shoppers feasted on cheap Chinese products, the average Chinese household was paying the hidden cost. A devalued yuan means anything made outside China becomes more expensive in yuan terms. A German car, an American iPhone, Australian baby formula, everything denominated in strong foreign currencies becomes harder to afford. Your savings don't travel well internationally. China's state and export-focused corporations accumulated power and profits, while household purchasing power lagged. That creates a huge imbalance. You can't permanently run a modern, healthy economy if your domestic consumers are structurally weaker than your exporters. By the 2010s, Chinese leaders understood that relying only on exports was dangerous. They needed to transition toward an economy where domestic consumption, people inside China buying more and better stuff, played a bigger role. But that requires giving households more purchasing power, which eventually means allowing the currency to be stronger, wages to rise, and the financial system to become more open. In other words, the exact opposite direction of the playbook that got you here. The tool that built the miracle also planted the ticking time bomb. After decades of being the world's factory, China developed a form of financial status anxiety. It was economically huge, but its currency didn't have the same global status as the US dollar or even the euro. The yuan was important, but it wasn't fully trusted. To change that, China launched a campaign to turn the yuan into a proper global reserve currency. A reserve currency is one that other central banks hold as part of their emergency savings. It's the financial equivalent of being invited into the inner circle. The big milestone was getting the yuan included in the International Monetary Fund's Special Drawing Rights Basket, the SDR. This is a small set of elite currencies used for IMF accounting and signals who the major players are. To get in, China had to show that the yuan was freely usable, widely traded, and accessible. Throughout the early 2010s, Beijing walked a delicate tightrope. They opened bond markets, set up offshore trading hubs, and promised reforms. To the IMF, they presented a face of gradual liberalization. At home, they still kept a tight grip on capital flows and exchange rates whenever things looked shaky. In November 2015, the IMF announced that the yuan would join the SDR basket, with the decision taking effect on October 1, 2016. Symbolically, this was huge. It meant the world's core financial institution was putting the yuan on the same list as the dollar, euro, yen, and pound. On paper, China had won a long-sought badge of legitimacy. But here's the punchline. In practice, the yuan still accounts for only a small slice of global reserves compared to the dollar and the euro. Central banks can hold it, but many don't hold much. You can't force trust just by changing the guest list. The world noticed that despite the SDR victory, China still tightly managed its currency and capital account when things got rough. So, what's the final bill for decades of devaluations, pegs, and export-led growth? You risk getting stuck in what economists call the middle-income trap. It's the nightmare scenario for developing countries. You're too rich to compete purely on cheap labor, but not yet rich and innovative enough to compete on high-tech and brands. Here's how the trap works. You get rich by being the cheapest workshop on the planet. Factories boom, cities grow, hundreds of millions escape extreme poverty. But as time goes on, wages rise. You're no longer the absolute cheapest. Capital starts looking at cheaper locations like Vietnam, Bangladesh, or elsewhere. At the same time, you haven't fully climbed the ladder into being a German-style engineering powerhouse or a US-style innovation machine. You're stuck in the middle, not cheap enough to win on cost, not advanced enough to win on tech. That's China's existential problem right now. The entire strategy of pushing the currency down to pump exports created a dependence on low-margin assembly line manufacturing. It didn't force the kind of messy, risky innovation that creates the next Apple or Google. When you can make good money assembling products someone else designed, the pressure to invent your own global brands is weaker. Manipulating the currency is like putting your economy on steroids. You get big muscles quickly, growth, exports, headline numbers. But if you never build the deeper foundations of innovation, institutions, and household wealth, those muscles don't age well. Now China is trying to make a leap to a high-income, tech-driven economy with a system originally designed for cheap labor and a weak currency. They gamed the rules of the old global trade system to climb up fast. And now they're discovering that switching to a new game mid-air is incredibly hard. The brutal part is that none of this was truly unpredictable. Historically, every country that tries to devalue its way to prosperity runs into the same wall. You can't suppress your own population's purchasing power forever without side effects. You can't forever build an economy where workers assemble goods they'll never be able to comfortably afford. China's leadership knew the trade-offs. They just bet they could time the transition perfectly, squeeze maximum growth from the weak currency model, then gracefully pivot to a stronger, more consumer-driven system later. Now, later is here. The pivot is proving messy, and the margin for error is small. The global implications are enormous. For 40 years, the world economy operated on the assumption that China would keep making things cheaply and reliably. Supply chains, trade routes, and business models were built around that premise. If that model breaks or even seriously changes, a lot of supposedly stable assumptions evaporate. Will China successfully move up the value chain and become an innovation powerhouse without a major crisis? Can it give households more purchasing power without destabilizing the system built on cheap exports and managed money? If China steps back from being the world's default factory, who fills the gap and at what cost? These aren't abstract questions. They affect the price of your next smartphone, the stability of your job, and the behavior of your retirement account. China's currency experiment was one of the biggest economic bets in modern history, and every person with a bank account is now a background character in that story. In the end, the saga of the Yuan is a story about incentives, illusions of control, and the limits of financial engineering. It shows how brilliant short-term tactics can create impossible long-term trade-offs. It reminds us that in economics, like in physics, you don't get to ignore gravity forever. You can play games with exchange rates, interest rates, and capital controls, but you can't permanently cheat basic reality. Markets, demographics, and math eventually present the bill. China got roughly 4 decades of spectacular growth helped by a weak currency and tight control. Now the bill is arriving, and nobody knows exactly how high the final number will be. The next few years will show whether China can escape the trap it built for itself, or whether it becomes the latest warning label about the dangers of trying to outmaneuver economic fundamentals. Either way, it's going to be one of the most important financial stories on Earth. If you want to keep watching this experiment unfold in real time and understand what it means before it hits your wallet, subscribe to Chill Financial Disasters so you don't miss the next chapter in this very expensive lesson.